I'm seeing a lot of retail investors make the mistake of focusing too much on dividend paying stocks where they will select one stock over another just because one's paying a dividend and the other one isn't. And if there's anything the markets have taught us over the last 5 years with the Magnificent Seven, these big tech companies, when you look at them, many of them pay no dividend or pay such a small dividend that they could have been overlooked by these investors. Focusing primarily on dividend paying stocks is what I considered old school investing, which is why when you inherit stocks from your parents and grandparents, a lot of times they were holding GE and Procter and Gamble, and the strategy was I just picked 10, 20, 30 stocks, I held them forever and collected a dividend. Where now markets have evolved, our economy's evolved, the types of companies in the stock market have evolved, where it may be shying away from that being the optimal investment strategy. When investors are out there screening for new stock holdings for their portfolio, I think there's a common misconception that a stock that's paying a dividend is safer than a stock that's not paying a dividend. And that's definitely not true. I mean, a stock that's paying a dividend can go under just as easily as a stock that's not paying a dividend, but I guess they have this comfort blanket that, hey, if the stock doesn't go up, at least I get my 5% dividend, which isn't the best investment strategy. Wouldn't I rather have an investment that has more promising growth prospects as opposed to just saying, well, if it doesn't go up, at least I'll get some income? It's also important to understand that dividends are not guaranteed. Just because that stock happens to be paying a 5% dividend right now does not necessarily mean that company could come on hard times and have to cut its dividend or stop its dividend altogether. We saw a bunch of this in 0809. So during the 0809 recession, there were companies like GE that were paying big dividends. So people had big holdings in GE, they were living off the dividend, but as soon as GE hit hard times, they cut their dividend significantly, and then those shareholders were forced to sell their GE stock after it had already dropped because the dividends were no longer enough to supplement their income, so they were forced into a sell-low environment. I'll circle back to something I mentioned into the intro, which is a lot of these Magnificent Seven stocks, the Googles, the Nvidias, the Metas, the Amazons, they've been leading the charge from a performance standpoint in the S&P 500. But what do a lot of those companies I just mentioned have in common? Some of them pay no dividend, and most of them pay less than a 1% dividend. It's all about growth to these companies. And it's not uncommon at all for growth companies to not be paying a dividend, because when a company generates net cash, they have a decision to make. They can take that cash and sock it back into the company and get more growth, make acquisitions, whatever they're going to do, or they can return some of that cash to shareholders in the form of the dividend or some combination of the two. Now, you can see where paying a dividend could almost be looked at as a negative light from a total return standpoint, saying, are they returning cash to shareholders because they don't have enough good growth prospects? Or maybe they're paying a dividend because they're trying to entice some of these dividend chasers into their stock. It's not always a positive thing. Which brings me to my next point, which some of these dividend paying stocks, they might be well aware that many of their shareholders own their stock for that 5% dividend or 7% dividend. And if they decide to cut that dividend, that may cause people to say, maybe I'll sell this stock and go into a company where it can keep generating that dividend income. So there's a risk to them of cutting their dividend, which can potentially cause companies to make a poor financial decision that if, let's say, the company comes under some financial distress, maybe they don't want to cut their dividend because they're worried that shareholders are going to sell their stock, even though it would be the prudent thing to do to build up more cash reserve to get beyond whatever's going on within the company. And some public companies have gone to the extreme of this, where they've actually taken on debt just to pay the dividend, which is the whole opposite reason why you're supposed to be issuing a dividend in the first place. So dividends are, hey, we have money left over, let's return to the shareholder. A dividend is not like, hey, our shareholders are getting used to this 5% dividend. We don't have 5% in cash, so let's go issue a bunch of debt in the form of bonds, raise cash so we can keep paying the dividends and keep the shareholders in their seats. By no means am I saying all dividend paying companies do that. I'm just saying when times get tough and you have these dividend paying stocks and people own it for the dividends, you just have to ask more questions, knowing those stocks may be under pressure to find ways to continue to pay that dividend without jeopardizing their shareholders selling the stock. This is why I'm a huge fan of focusing on total return, which is the appreciation value of a stock plus its dividend, to do a true apples to apples comparison. Because if I blindfolded someone and say, hey, here's company A that pays a a 5% dividend, and company B that doesn't pay a dividend, a lot of investors will immediately start anchoring towards a dividend because they feel that level of safety. But if over the next year, company A goes up by 8%, you're like, oh, I did pretty good. I got an 8% rate of return, got my 5% dividend. That was a 13% rate of return. But what if company B went up by 30%? That crushed your return, even though you had the nice comfort blanket of the dividend with company A. Now, with all that said, as an investment advisor, diversification is super important. So by no means am I inferring that everyone goes sell their dividend paying stocks and hop into these hot growth stocks. It's more about understanding some of the biases that I feel exist in the market, that somehow dividend paying stocks are safer, are better than stocks that don't pay dividends, where what we've seen over the last 5 years is not necessarily from a total return standpoint has that approach been superior. While we're on this topic of diversification, it's also important to understand whether you're in the accumulation phase or the distribution phase of your investment life cycle. So when we look at accumulation phase, meaning I'm 40 and these are retirement accounts and I have another 20 years to accumulate, you may be able to have a higher risk tolerance around some of these growthier stocks, because if they go down, you're not taking any money out, you still have another 20 years for those things to go. Versus if you're in the distribution phase, I'm retired and I'm actually drawing down on this portfolio, you have to be a little bit more careful with total return, because if these tech stocks take a big dip, and let's say you need $50,000 a year out of that investment before they'll live off of, no matter what's going on in the market, you are essentially forced to sell these higher volatile stocks at lower levels, which could diminish your rate of return over time. I hope this information was helpful. An important disclosure on this video, because it was very investment heavy. We are an investment firm, so none of the securities that I mentioned in this video is an actual recommendation to buy or sell those securities. For recommendations, please consult your personal investment advisor. Thank you.